big challenge is going to be digital. And I think a previous banker, the Citibank head in the US, described it well when he said, I'm basically a technology company with a banking license now. It's going to get as technology as that. Now, this is where the Google Pays and phone pays become a very big challenge. In practically a year or two, they've taken away a large part of the game. What do you think is the answer to ensure that it doesn't happen again? But more importantly, how does the banking system reply to this challenge? Are you all getting together to put out a common gateway? Because that 30% is available, NPCIL does want to restrict the others to 30%. Is there anything in the offing to grab that 30%?
I think when we talk about the big techs in the financial services space, we're essentially talking about the payments, right? They're not yet into other areas of banking. That may not be far away. We have to be prepared for that. Obviously, I think many of us have missed out on the payment space. We missed the bus. But today, if you see in terms of the volumes, banks like SBI, as a primary remitter bank, we handle a huge amount of transactions. While the intermediaries like TPAPs, what we call third-party payment application providers like Google Pay and all, of course, are the major participants in this. So what is required to be done? I think it's no point in actually revisiting on the payment space. Payment space is highly commoditized.
Do you lose data because it goes away to a Google or a phone pay?
So I think even as a remitter bank and the receiving bank, if you really talk about the data and our ability to utilize the data for building any models, it is still with the banks. That's what I feel. I think while the information which is flowing through the payment application providers are significant, if we have right analytical models, we have the data both as a remitter as well as receiving bank.
So you don't think you'll have, the Googles, the GPays have eaten your breakfast as it were?
I don't think we are wanting to be there.
Okay.
And we have not missed out on any other thing if you really get it right.
Okay. Shyam, you think banks are safe? Before I ask what banks can do for the country, I'm asking for banking survival itself. Do you think that banks don't have to worry about fintechs? RBI is there after all.
No, see, I think that's the point I heard both Sethi and Kumar speak. I don't believe it's a matter of threat or survival or any such thing. First, please understand the revenue pools where they are sitting, right? There's lending revenue pools, there's transaction data revenue pools, and there is liability or deposit revenue pools. So, by the fact that an intermediary or a payment company has the access to transaction and payments doesn't automatically mean that they are conquering all the revenue pools. So to believe that the banks will have a challenge, and it will sort of threaten their existence is probably misplaced.
Instead of looking at challenges for banks, to what extent can banks intermediate, or are they prepared to intermediate the India decade, as it were? And there the big question, Mr. Sethi, is infrastructure. At the moment, everyone is in retail. No one's talking about big infra projects. And when it comes, will you have the appetite? Will the banking sector have the appetite or even the balance sheet? For long-term money.
I think when we had so-called twin balance sheet problem, obviously, when the credit growth had come mainly from the retail. And the consumption patterns also have encouraged and easy. And also, see, let me tell you, digitalization also had helped in growing the retail book. Today, any retail lending operations are expensive, operationally expensive, right? To distribute 100 crore worth home loans is extremely difficult than
much more expensive than writing a 100 crore check to one company.
But the digitalization and technology definitely had helped us to scale up the retail. And today, we keep saying that, we do our pre-approved personal loan in 3 seconds on our, app, and the volumes can be tremendously built up there. So I think the ease of delivering the credit and also the demand for credit has definitely increased the retail. Whether, what is the ideal ratio for any bank to have? Is it, we were 40-60, in the sense 40 retail and 60 corporate at one point of time. Today we are 60-40.
The point is, the entire banking sector kind of paid the price for its fascination with infrastructure from, say, 2005 to 2015. So have you all gotten so scared away that, you know, you would, and retail is so much more easier and risks relatively distributed. Will there be a challenge from the banking sector to even fund infrastructure?
So definitely the retail lending is attractive for everyone. Whether large banks or small banks, NBFCs, MFIs, everybody is going into the retail. When we talk about retail, it is not pure play personal retail, it even MSME, all that gets added to that. So if you talk about infrastructure, I think let's also look at the numbers. I think anecdotally, everybody is saying that, you know, no infrastructure funding is happening in the country. If you see 21-22, there were 930 projects which were announced by the private companies, right? Which is almost 2.6 lakh crore commitments. And if 22-23, if you say, I think the numbers almost pan out on the same level. So this investment aspirations are going to get released in 23-24. We expect that if you take SBI alone, we have said that our pipeline of infrastructure is almost 1.6 trillion. So I think, well, whether it will be again a public sector bank driven infrastructure financing or private sector and public sector together, we'll have to see. But one thing what we have learned in the last NPS cycle is that what needs to be done right. I think infrastructure financing has taught many elements in terms of, you know, before you underwrite. One is if you have to
first get the land.
And right of way. Right of way is a big issue, right? And also the permissions. Today,
so you think the banking system is wiser?
We have more wiser, and we have strengthened our underwriting standards, number one. Number two, I think a lot of principal agencies also have realized that the banks will not lend unless I take these steps. NHI today is assuring us 90% right of way before I give the road project. I think we are poised. We have learned our lessons. We have tightened our underwriting standards. And we also are able to say no to a project if we are not satisfied.
Is foreign capital ready to finance Indian infrastructure? Is the capital market ready to finance? We don't see debt market of any kind. I mean, we only have a GSEC market. And we have a bit of an NBFC, probably a bit of a CD market and an NBFC bond market. Is the capital market ready to finance?
Yeah, so if I can just frame this, Lata, I think if India has to meet our growth aspirations and kind of given the stage of development we are in, I think we need to increase the spend on infrastructure from the current 5 to 6% of GDP to more like 9 to 10% over a period of time. Most of the investment till recently has been public sector or state driven. Private sector needs to kick in. So the demands are going to be immense. In my view, bank lending is not going to be enough to meet that needs. Loans is not going to be enough. Domestic supply of capital is not going to be enough, which means we need to kick in, and you mentioned, sir, about takeout financing from, so you need more investors coming through, and I think the fact that REITs and InvITs have started to get good response, I think is a great start. We've had a number of recent highways, REITs, and I think you want to see more of those pension funds, sovereign wealth funds, infra funds coming through. A lot will become about risk allocation. Frankly, in my view, banks should be focused to take pre-completion risk, and post-completion, as Mr. Shetty, you said, you should be trying to term it out in the capital markets, which is the model which has worked wonderfully well in the US and Latin America. Because banks should not idly be putting on 15, 20-year assets on their balance sheet. That's not what their funding model is designed to do. So I think till we can get a lot more players in, can we get the right risk allocation?
Are you satisfied or confident that we are prepared for the next infrastructure cycle at all in this country?
No, I think there are two realities, I said. First is that we need the massive growth and investment in infrastructure as a given. That's going to happen. And we're seeing, like Mr. Sethi pointed out, even in FY24, the one that we're sitting in the first few months of this year, we've seen more proposals coming in than I think the greater part of last year. So there is.
Did you sign on them? Did you accept those proposals?
See, I think that I'll go to Ashu's point. Banks are not entirely into signing off on 15, 20-year credits, right? So we have to be quite thoughtful about it. But the first point I was going to make is there is active demand, and it is beginning to show up, and banks are getting projects. Depending on each one's funding, balance sheet capability, you will take on risks, and that is already happening. Now, is everybody sort of panicking that, oh God, the recovery mechanisms are not in place and therefore we will not? I would go back to what Mr. Sethi said. A lot has been learned and a lot has been put in place at this point in time, to the extent that I don't think those are sort of stopping us from doing what we have to do to support these projects, and in particular, projects that are seeing good traction given where we are. I think the NHAI projects, the hybrid ones, we are seeing action. We, as a much smaller bank and a much smaller balance sheet, are willing to take that risk. A year back, 2 years back, we were not doing that. And so to that extent, there is active work going on and willingness to take on risks. We are also seeing that the ability to need to face an IBC kind of situation is well addressed upfront. You're able to get structures that are more in support of going ahead with this. And I think when Sethi said NHI giving almost 90% protection, these are fundamentally game changing, I would think. And I'm reasonably sure that the next wave of growth in all credit, and in particular the high ticket long-term financing, you're not going to see the amplitude of the problem as what you saw. In fact, the good news is India of 23 and 25 and 28 and 2030 is not India of 4, 5, 7, 10, right? We've seen a lot more data, a lot more analytics, a lot more information, a lot more organized structures around it, which will support growth, which we are seeing already. And the level of information available and for the bona fide customer to go astray, the opportunities are very limited. Unless it's a fraud, that's a different story. But if he's a bona fide borrower, irrespective whether it's corporate, retail, individual, commercial, SME, I think the infrastructure in the country has made sure that you can't go hugely astray.
When the IBC came, it already had a backlog of cases. Now it will only get incremental cases. You also have acrylic, where, the default has to be immediately reported now, and maybe cases will not, become very mature and bad. You think, therefore, the next cycle won't be so vicious?
Yeah, I think just to answer your question, I think it's your favorite question that, why IBC is not delivering today. I think early successes also have built up the expectations from these relatively new, legislation. But having said that, the institutional capacity has to be strengthened. I think that's very much required, both in terms of the number of members, number of benches. I think government is working seriously on that. As Prashant says, admission is the critical process, and then we'll take it forward. But the offshoot of the whole insolvency process in the country is that today, when we are underwriting, when we are structuring a loan, we are actually keeping what can go when you go to the IBC, what can go wrong, or how do we prevent a loan actually going to the insolvency. This is a major, major benefit of that. In fact, I always tell my underwriters is that earlier our documentation was just a documentation, it's a paper, right? Today, every covenant, every structure, every security package is designed in a manner that, what happens when I go to the IBC process. Because these were not there, it had led to a lot of litigation, a lot of, discord among the COC members. You had first charge, second charge, there were fourth charge, fifth charges also. Yes. So all these structures are now understood in a better manner. I think that way, apart from Krilsi, what you mentioned in terms of, better monitoring of what is happening in the credit, the structures itself have enabled in a manner that probably we don't have to go to IBC at all.
So just for those of you, I think all of you are bankers, but the CRILC or the CRILIC he referred to is the database which the Reserve Bank has, and the first default delay in payment by any entity has to be reported to the Reserve Bank that Friday. So hopefully, you can't go bank shopping, default with one and take from another, because the system now is more aware. Hopefully it will not be that bad. India is still a seriously underbanked country. I mean, for all the Jan Dhan accounts that we have, it is still only an account, and even that I think is what, 80% or 85%. And over there, it's not as if everyone has credit. So, Mr. Sethi, to start with you on that, do you think banks have the wherewithal, or if you want to expand it to the financial system, banks plus MFIs plus NBFCs plus fintechs, are you geared as we go towards a 5 trillion and a 10 trillion economy to service the last man in terms of loans?
Yeah, I think it cannot be done only by the mainstream banks. That is established, because one is, of course, the cost structure, and number two is that the last mile connectivity is still an issue. Despite having the largest branch network, we still feel that we are not able to really reach the... So it's a combination of the mainstream banks with capital providers, and then you have NBFCs, MFIs. I think the whole ecosystem has to work. And the concept of funding a thin file customer, the usual word which they use, as we are borrowing from the NBFCs and MFIs, honestly, and how do you finance a thin file customer is data driven essentially. So we have the data, and if I'm not able to deliver to them, I can always use the co-lending models, which is again another concept, which is quite useful. We have to get it right. The technology would enable us. So in terms of reaching the last mile, a combination of mainstream banks, NBFCs, MFIs, backed by the data and the capital provided by the mainstream banks is quite useful, I suppose.
Shyam, we're going great guns as far as retail growth is concerned. Banks are moving from probably 35-40% public sector banks, retail, to now well over 50, some of them even 60-65, and private sector banks are already at 65% retail credit. What if the cycle turns? Are we, unsecured credit, I think already the Reserve Bank has raised that red flag. One economic downturn can lead to a lot of issues in terms of collecting. As Mr. Kumar says, collecting is always more difficult than giving. Do you think we are prepared for that? Are we heading into a likely problem on retail credit?
Now, in another conversation with you a few days ago, I explained the situation. Let me repeat myself. I think, will there be some cycles? Absolutely, yes. All right. Is that cycle upon us right now? I don't believe so. Second, even if the cycle were to arise, we must understand the level of bad cannot be what it was in the past, only because of the reasons we spoke a while ago in terms of the architecture of the ecosystem of banking today is materially different than it ever was. We all leave digital footprints all around us, and it's something that you and I cannot escape. So that data, banks, financial institutions, NBFCs, whoever they are very thoughtfully mining it to make the best sense of it. So unless, and I keep repeating always, unless the intention is to defraud the system, a bona fide borrower today is most keen to honor his commitment and pay. So if you take the last 25 years of Indian banking and look at it, which you've done all the while, the amplitude of credit bad has started coming down from 20% NPA to 10 to 3.9, likely to go to 3.5. The worst case now it can go to 5%, 5.5%. It's not going to go back to 10%. Because all we asleep at the wheel to let that happen. So I think we can be quite sure that the Indian banking system is in a place where the level of bad will not be what it ever was. That's one is given for the reasons I mentioned in terms of the ecosystem, the development of technology, the smarts that people have developed to ensure that you are well insulated. Second, I think our belief that unsecured is equal to necessarily bad is actually beginning to get challenged, because the unsecured borrower, particularly the younger, newer borrowers, don't want an impaired credit history. If you see in the recent past, the unsecured behavior popping up to some extent, it's not the existing customers of banks that are causing this problem. It could be the exuberant lending at the bottom end whom we are trying to bring it into the system. And there's a good chance that they are repairing their credit history once the collection process is upon them. So I don't think you will see bad rates as high as it was. Yes, will there be some sort of uptick given the if there's a slowdown in the environment, you may see that, but I am reasonably convinced that the level of that will be way lower for the reasons that we've all been talking about. But I'll just go back to one point when you asked the earlier question on credit to the bottom end of the pyramid. I have to say, Lata, the digital lending, and you probably are aware that we're doing Kisan credit cards using digital technology, along with RBI hedge. It's a farmer loan, right? 1.6 lakhs. It's 5 seconds. 5 minutes. That's all it takes. And that at scale is going to change quite materially. It can be 20, 30,000 crores credit opportunity for farmers and dairy farmers and, paddy farmers, a range of them. A bank of our size, we are seeing scale. And I can't quite imagine what it will be like an SBI or somebody went unleashed. So for sure, that's going to be a great bottom of the pyramid, a credit expansion opportunity. I'm seeing that already happen. And coming back to your point on retail bad, I would think it will be way lower than it ever was. Will there be an uptick? Yes, but I think the smart system, the ecosystem ability to catch early, detect early is improved materially. I don't think it will deteriorate to the extent that we saw, say, even 3, 4, 5 years ago.
What would be your ask?
I think three things. First, I think both government and Reserve Bank, if they continue to support the way they have done for the last 4 or 5 years, I think that is very, very important.
Okay.
The second would be in terms of, I think, the real improvement in our recovery processes. Because the recovery process is
not good enough.
Not good enough, whether we talk about the IBC or the legal process. I think there is a huge requirement to streamline this part. And the third is definitely in terms of the priority sector. I'm not saying like we reduce the overall, but I think we are creating so many subcategories within the overall priority sector where banks would be finding it very, very difficult. And ultimately, who is impacted? If the banks are not able to make money, it's ultimately the common person or the depositor who are impacted. So maybe because this is the requirement of the country, we can keep an overall part, but not in the subcategories on the priority sector.
Shyam, your ask, and I'm wondering why I didn't get that from the other two bankers. Maybe my thinking is wrong. See, when the Adanis bought the cement companies, none of the banks could finance it because takeover financing is not allowed. They had to take foreign money. A ripe fruit was not available for the Indian banks. You think those rules need to change? You should be allowed to finance takeovers?
No, before I answer that, Lata, I think the question you asked some of them, I hope I'm not misinterpreted, but I believe the collaboration between fintechs and banks is probably less understood. And sometimes innovation happens at the fringes of regulation, right? That's how it works. Where you control, where you let go is always the challenge. And I say that because we work very closely with fintechs, and there is always that nervousness: are we stepping over and going to get into trouble? But I think a better appreciation of that will help to inclusion, spread the credit expansion, get customers from unbanked categories into banking system. I think there's a huge opportunity. So if you ask me for an ask of the regulator, I would encourage more dialogues around how do you make sure that what looks like an adventure is actually allowed, but within a boxed environment, and then you can scale it up. So that
They allow sandboxes.
Yes, they do. Yes, they do. But I think what happens in all these things is that there are some silos that do, but whether it breaks or whether it overrules some existing regulations needs some more thinking around it. Now, when I say these things, it can be misinterpreted, but I think the message is very clear. We have to do more in that space to ensure that it can truly be expansionary.